Let's talk about another important, major law in our industry, the Real Estate Settlement Procedures Act, also known as Reg X. Now, this law came about in 1974, and the main purpose is to educate borrowers on their loan costs. So we got to disclose to the borrower costs. So there are disclosures required under TRID, the TILA-RESPA integrated disclosures. There are notices about escrows and transfer of servicing and affiliated business arrangements, and the enforcement arm at the federal level is the CFPB. All right, so let's jump into this thing. So the Real Estate Settlement Procedures Act, also known as Reg X or RESPA, is the companion law to TILA, the Truth in Lending Act. It was enacted to protect borrowers in purchases, refinances, home improvement, to understand the cost of this loan. Now, RESPA covers properties that are 1 to 4 units, condos, manufactured housing, but RESPA does not cover certain transactions. Now, when you go to take the test, I want to give you a mnemonic device that will help you remember those exempt transactions of RESPA. So RESPA does not cover large tracts of land, say 25 acres or more, even if there is a home on it. So think agriculture. RESPA doesn't cover business loans or commercial loans. RESPA doesn't cover temporary financing, such as bridge or swing or construction loans. And RESPA does not cover vacant land. It's got to have a house on it. So what is an easy way to remember agriculture, business, or commercial? Just think ABC. And when you think of temporary financing or vacant land, think of TV. So the mnemonic device I want you to remember is RESPA does not cover ABC, TV, agricultural, business, commercial, temporary financing, or vacant land. So it educates borrowers about the costs of their loan, but RESPA also is meant to eliminate some negative features such as kickbacks and referral fees that tend to inflate the cost of loans. It also limits the amount that you can charge a borrower to have their impound or escrow accounts for the payments of fire insurance and taxes. Now, over the years, RESPA has changed. So initially we had a good faith estimate, and it was used for all transactions. Now it's only used in home equity lines of credit or reverse mortgages. The good faith estimate outlined the costs associated with the loan, which was required to be disclosed to the borrower within 3 business days after receiving an application. RESPA also required a HUD-1 settlement statement. It was a document that had a whole bunch of numbers telling the borrower, okay, in the good faith estimate, we told you what the cost would be. Now at the end of the transaction, now that we're signing all the papers, these are all the costs and who do they go to? In 2015, TRID, or the TILA-RESPA Integrated Disclosure Rule, was created that replaced generally the good faith estimate and the HUD-1 settlement statement on most transactions, and now created a new document called the loan estimate. So the loan estimate that we use today most of the time replaced the good faith estimate and truth in lending disclosure statement that was used in the past as a repeat. Now we have a GFE, good faith estimate, and HUD-1 settlement statement only on home equity lines of credit and reverse mortgage loans. Recap. RESPA is a law that pertains to us and how we disclose information to the borrower. RESPA is a disclosure law that says we need to send out that loan estimate to the borrower within 3 business days of receiving their application. I want you to think about this. This is the biggest transaction that individual is going to make, their home. It's the transaction that they're going to pay on for the longest period of time, 30 years. They need to know what they're getting into. They need to know the costs, where the costs are going, who the costs are being paid to. They need to know it early, within 3 business days of the date of that application. There are different sections to RESPA. The one that is really important that you need to understand is called Section 8 of RESPA. It was created to eliminate the payment of referral fees, kickbacks, and unearned fees between parties in a real estate transaction, putting the borrower at an unfair disadvantage. Section 8 also looks at business relationships called affiliated business arrangements. So an affiliated business arrangement might be a person who refers business to a settlement service provider for a federally related mortgage loan. Now, let's say they have an ownership interest of 1% or more in that settlement service provider. Now, let's say you directly or indirectly refer business to that provider. So here's an example. Your company's CEO has an ownership interest in a title insurance company. If you want to refer your borrowers to that title insurance company, then that affiliated business relationship must be disclosed between the company that you're working for and the title insurance company. So you cannot require them to use that particular provider. You must disclose and let the borrower decide if they want to go ahead and, now that they've got the disclosure, they go ahead and decide to use that title provider or not. Section 8 also states that no person may give or receive a fee, kickback, or any other thing of value. So that means you can't give or receive any portion, split, or percentage of any charge for any settlement service that wasn't actually performed. And RESPA also covers costs associated with a loan, and it states that the fees must be reasonable. Now, Section 8 doesn't prohibit payment of a fee to, say, for example, someone that actually does something, say an attorney or a title provider, or you as a mortgage loan originator being paid for services you actually performed. Or say there's another employee, a processor, or somebody else, their salary, their compensation, their bonuses, as long as that compensation is based on, services that they actually performed, you're okay. Well, Dave, it's federal law, Section 8. I mean, it's my buddy. I'm going to refer business to him. So what? If someone violates Section 8 of RESPA, you can be faced with a fine of up to $10,000, 1 year in prison, or both. Now, how would you like to take a year out of your life where you're not generating revenue and still have to pay a fee? Well, Dave, maybe. No, it's not maybe anything. You don't want to do that. You may also be required to make payment to the damaged, borrower up to 3 times the original fee that violated this section of RESPA, Section 8. And if more than one individual is damaged, all parties are liable to the damaged borrower, both jointly and individually. So please, this is something you do not want to get into, okay? You will be tested on this almost every day of your career. Let me give you a short story. I'm in a commercial complex. This is real. And there's a local insurance agent that opens up shop, comes over and says, hey, listen, if renters now become buyers and they need homeowners insurance, if you would throw my name in the hat with a couple, 2 or 3 others so the borrower can choose, that would be great. So throughout the year, we sent some business their way and also recommended other companies, right? Christmas time, the insurance agent came over with a $250 gift card to say, hey, thank you for the business. I understand what they're trying to do. They're trying to be nice. 1, I cannot give and I cannot receive a thing of value. We had to very politely say, sorry, but we cannot accept that because, we're just trying to help the borrowers. If you can help them out and you can reduce their costs, cool. We cannot receive that. I just used the story of the Visa card from the insurance agent. Nice person, but he was providing a thing of value. RESPA broadly defines a thing of value as money, things, discounts, salaries, commissions, fees, a duplicate payment of a charge. Yeah, if you are referring business, like I was doing, to that insurance agent and others, right? You could be influencing that borrower to a particular provider of a settlement service. If you do that, be very, very careful, okay? Not all referral agreements fall under RESPA's referral restriction. And off the top of my head, I think I can think of 3 exceptions. 1, educational activities. So you could have a first-time homebuyer. You could provide food. You could provide prizes. You can do activities. And let's say you're doing it jointly with a real estate agent. Be careful. If you're going to pay the expenses of the real estate agent, that would be a RESPA violation because it's a thing of value. But if you're paying your portion or your proportional share and they're paying their proportional share, you should be okay. The second one is payments for goods or services actually provided. So the fee needs to be equal to the market value of that service that it's provided. Anything in excess, well, that would be considered a violation of Section 8. And then the third one would be affiliated business arrangements. You can do them with proper disclosure. Now, based on these definitions, there are some gray areas regarding with what is and what is not allowed under Section 8 of RESPA. Now, each situation needs to be analyzed to determine whether it is or is not a violation. Here's a couple of examples. Let's say you take your real estate agent, or a prospective real estate agent out to lunch to introduce yourself, your services, your pricing, things like that. Can you do that? Can you take an agent out to lunch? That's okay. It's called marketing. You're marketing yourself, right? But real estate, agent, and lunch, it would be a violation to send that same agent a restaurant gift card as a thank you for referring a borrower, right? So there's a referral there, and now you're sending the agent a thank you. Oops, you cannot give a thing of value for a referral. All right. Now, let's say, for example, the agents want you to come into the office and you provide juice, you provide donuts. You're providing now content for a training for real estate agents on new mortgage products. Can you do that? Answer is yes. But let's say the insurance agent says, wow, you're a great presenter. Can you present our continuing education for us to renew our licenses? The answer is no. It's not acceptable for you to pay for that real estate agent's continuing education or for their license renewal. All right. Can you lease space from an agency paying fair market rent? Okay. I mean, like you're renting their conference room because you want to have closings in their conference room. Can you do so? Sure. But can you pay more than the fair market value for that conference room? Again, the answer is no. So hopefully you guys are starting to see a difference. You can send, say, an agent or a builder seasonal candy bearing your logo or information, okay? It becomes a problem when you only send boxes of expensive candy to those agents that are referring you business as a holiday gift. Let's say you are attending and you are providing food to a real estate caravan. So realtors are coming in and out, and you're in this house and you're providing food and your signage that talks about you, your company. Absolutely cool. Not a problem. Again, it's marketing. However, one of those agents says, ooh, I need for you to cater my open house. You've crossed the line again. So, like let's say, for example, an agent has really referred a lot of business your way. And let's say you're in a market that has a major sports team. You cannot purchase tickets to that sporting event or concert or an agent's round of golf. That would also be considered a violation of RESPA Section 8.